Hello class, let's look at our homework for chapter 12, starting with problem 48. So we have a partially like-kind exchange in problem 48 where we are exchanging real estate and stock for real estate. So when we are giving up boot that's not cash, we're going to have to first calculate the gain realized and recognized on that boot, in this case the stock. So the stock had a basis of 18,000, but it was worth 25, so we're going to recognize a gain, realize and recognize a gain of 7,000. So now the stock plus the real estate we're giving up, the basis in the real estate, our basis in the stock went from 18 to 25 with this recognized gain. That means our basis in the assets are given up is 43. Fair market value of what we received is 67. So our realized on this exchange is 24. You did not receive any boot, so you do not have to recognize any gain in this like-kind exchange. And then, so that zero recognized, leaving us with a basis in the new real estate of 43,000, which is a fair market value, minus our postponed gain. Problem 49, we have a office building with adjusted basis 45. We receive from Miguel. We're going to exchange again, like kind. Exchange for, he's going to give us $15,000 in cash, a warehouse, and he's going to assume our mortgage. Okay, so that assumption, mortgage is added into what we receive because he's going to pay it instead of us. So that's, we're relieved of that debt. So our realized gain is the difference between what we receive from Miguel and what our basis is of 40,000. We only recognize gain up to the amount of the boot, but both the mortgage assumption and the cash together are boot. All right, so that's how much gain we're going to recognize, 35,000. So our basis in the new building is the fair market value minus the gain postponed, which is only 5,000 in this case. So 50,000 minus 5 is 45,000 basis in the new building. 53, which of these would count as replacement? Only the first one would not be, because you cannot replace a residence with a rental. With the others, it does not matter about where you have the warehouse or apartment building, as long as you have that same relationship, meaning if it was rental or used in a business before, it needs to be rental or used in a business afterwards. All right, 54, our office building destroyed by fire. So we lose our office building, the basis was 410. We get 550 for insurance proceeds because of the rider in the policy. That's why it's so much more. So we have 140,000 realized gain. If we spend all the money, then we have zero recognized gain. We spend all 550, none of it is recognized. And our new basis in the property is 410. If we don't spend it all, we still have a realized gain of 140, because the realized gain is simply the difference between these two numbers here. But if we didn't spend all of it, the amount we didn't spend is the amount of recognized gain, 55 in this case. Our new building is 495 minus the amount of the postponed gain, which is 85, so our base is 410. Notice that these are the same in this case. On the last one, if you don't spend, don't rebuild, you're going to recognize the full 140,000. It's both realized and the recognized gain. 56 is an installment sale. We're selling land. We have an adjusted base of 25. Our sales price is 90. Our profit percentage is 88 something. And you can see the formula here. You take the sales, you minus the adjusted basis, including the selling costs. And then on the bottom, or the denominator, you take the 90,000 and you subtract out what the assumption, the 18,000 that was assumed. That doesn't count towards how much cash you're going to receive, and therefore you don't take it out when you take it out when you're calculating this profit percentage. Then you just take the amount you received in cash times the profit percentage. Now, it says to ignore interest, so you didn't have to do anything with that, but make sure that this installment sale has an interest rate that's reasonable. On top of that, it would be recorded as ordinary income. But if you don't, you're going to have the IRS what's called impute interest. We talked a little bit about that in, I think, Chapter 3, that we can impute interest if it's not there in this scenario. All right, problem 58. We sold our primary residence. We had a realized gain, but it was recognized as zero. You can exclude up to $250,000 if you're single, $500,000 if you're married filing jointly, and the new home has no basis. I mean, has the same basis what you paid for it. Nothing to do with the old sale. It has anything to do with the new house. Because this is not a postponement, this is not a carryover or anything like that. This is simply an exclusion. You just do not have to actually report it or pay taxes on it, as long as it's under the $250 for the single. All right, problem 60. We've got basis in our stock of 100,000. We're going to sell it for 88. So it means we have a realized loss of 12,000, but because we rebuy the same stock within 30 days after or before, doesn't matter which direction, then it's going to be a wash sale, and therefore you cannot recognize that $12,000 loss. Instead, you add it in, okay, that unrecognized loss onto the basis in the stock you buy, and it would be up to $139,500. So if you, last one kind of throws at you the idea if they only repurchased 100 shares, then you've got a wash sale for 100 shares and you've got a non-wash sale for the other 50. So the 8,000 would be not recognized and added to the basis of the new property, while the other 4,000 on the other 50 shares that was not replaced could be recognized. So it's you can't have a partial wash sale. And number 61, our last one. This time, instead of selling it with a wash sale, we're selling it to a related party. And so you have a realized loss, but again, it's not recognized due to it being a related party sale. It doesn't work quite the same way. You can't just automatically add it to the basis like you could with a wash sale. Instead, it depends on what happens when the person you sold it to sells it. If they sell it at a loss, you cannot add or increase the loss with the related party. So that $25,000 is gone forever and ever. Doesn't do anybody any good tax-wise ever in scenario A. If they sold it for $80,000, then they can use the $25,000 unrecognized related party loss to offset the gain on the sale, a subsequent sale. It would have been $30,000 gain, but you can offset it by the $25,000 from this original sale. So you can think of it as reducing the gain or increasing the basis, however you want to think about it. However, if they sell it for $65,000, they can offset the $15,000 gain, but the other $10,000 is lost forever. So there would be no benefit to anyone for that other $10,000. Again, the kind of thing that you should tell your clients not to do based on this process and what we know about this. Don't sell it to your kids at a loss.